If you are not watching these 5 stocks in May of 2026, then you might be missing out on a huge opportunity. I'm going to be breaking down exactly why I'm watching them and why I think they're going to provide huge long-term returns. Let's get into it. Okay, so every month I do put out a list of the stocks to watch that I am watching, and so my top 5 that I'm watching right now are HIMS, Celsius, Salesforce, NFLX, and ServiceNow. So I'm going to be breaking down exactly why I think these stocks provide really good opportunities for investors and just how much of an opportunity you can actually get from it. So if you can, please give a like and subscribe. I really appreciate it, but let's get into it. First and foremost, I do want to show you the performance of all of these stocks, right? So HIMS, in the last 1 month, 6 months, 12 months, in fact, all of these, right, you can see the numbers. Now, they are all in the red. I like to buy stocks that are good quality companies, but the stock hasn't performed very well. So you can see the stock is, all these stocks, the performance has done absolute just horrible for 12 months. Celsius, not so much, but in the 6 months, 44% down, right? So, but these are all good companies. They're all really good companies. I'm going to be breaking down why. I'm going to be breaking down how much money they make, all that stuff. But again, I like to buy companies that are in a bad spot on the stock, but good spot in the business. And I believe all of these companies are in a good spot in the business wise, but the stock hasn't done so well. And I think this is when you can actually get the biggest returns. So first and foremost, we are going to go with HIMS. And if you do watch my channel at all regularly, you do know I talk a lot about HIMS. And so $2.35 billion, this is their latest, there's a Q4, right? So it's the whole 2025. And so it's $2.35 billion for the whole year of 2025. It's about 60% increase year over year. Their net income went up only 2%, but that's because they've done a lot of investments, because their adjusted EBITDA was up 80%, operating cash flow was up 20%, free cash flow down 71%, because again, a lot of investing they were doing. Subscribers went up 13%, and the monthly revenue went up 28% to $83 a month. It was the monthly revenue per average subscriber, right? So they're doing well, and they still maintain their $6.5 billion of revenue by 2030. So they have continued to stick with that number, and they have not inched away from that. They're also a obvious share, market share leader, right? They're dominating by over 50% in observed total sales, right? Total customers, almost 50%. So they have half of the market right now. They just released, they did the deal with Novo. So now they have the Wegovy shots, they have the Wegovy pill. So now, and the Ozempic. So they have all the options now available. The Novo lawsuit, done. The FDA, all that stuff, it's gone. Right now, HIMS is just moving forward with business. So that's good. Now the next stage, right? Novo, okay, GLP-1s, they've already been doing that, but they made the deal with Novo, and now things are going to go. But what's the next step for HIMS, right? Peptides has been the talk about the future of healthcare, what they can do. Right now, they are injectable only, and so I'm going to kind of go over that really quick. But I want you to hear what CEO Andrew Dudum says about HIMS and what they're going to be doing with peptides.
We launched GLP-1s and everyone said, oh, now you're just a weight loss business. And, a year from now, people will say, oh, you're just like a peptides business, probably, if I were to take a guess.
So obviously, HIMS is going to be doing a lot of things with peptides, right? If they're saying they're going to be seen as a peptide company, when right now they're being seen as a weight loss company because of the GLP-1s and Novo. And if in a year they could be seen as a peptide company, they plan on pushing peptides here in the next 12 to 18 months. So recently, it was February of 2025, they started expanding into personalized peptide therapies. That they did an acquisition. They acquired a California-based peptide facility, and then their target areas is to focus on peptide innovation for metabolic optimization, weight loss, preventive health, recovery science, and cognitive performance. Also, hair and skin care. HIMS does use peptides and products designed for hair growth. And then the future outlook, the company is positioning itself to lead in the preventive health and longevity space, anticipating relaxed FDA regulations on compounded peptides, which that's very possible, and we'll get into that in a second. Now, why are peptides the future? They have precision targeting, they mimic natural signaling molecules, and they have very few side effects. They have lower toxicity, and faster development. Peptides are often easier and cheaper to design and produce rather than the large protein biologics. So that's good. Now the oral delivery, if you're taking a pill, it's a lot easier. People do not want to be injecting themselves with any kind of no one really likes to put a needle in them. Okay, no, I don't want to say nobody. There's people out there that like it, but people would rather take a pill. So here we go, right? So if you can get the oral delivery, the pill, that's the holy grail, right? So whoever gets that, which right now we have some of the GLP-1s going in pill form, that is the start of a major breakthrough and in terms of being able to for consumers, right? Consume a lot more. Like your addressable market, right? Your total addressable market expands tremendously from a lot of people who don't want to put a needle in them to now you can just take a pill. It's amazing. You also have neurodegenerative diseases. Peptides are being engineered to cross the blood-brain barrier to treat previously untreatable conditions like Parkinson's and Alzheimer's. So peptides is so powerful, so strong, so good that they can actually help out with Parkinson's and Alzheimer's, which there could be a great market for that as well. You also, if you have heard, there's these superbugs that have become resistant to all of our antibiotics. Well, peptides can physically disrupt the bacterial membranes, making it much harder for bacteria to develop a resistance. So again, it's just another use for peptides. And then of course, AI, artificial intelligence, is now being used to screen trillions of peptide sequences to find the perfect fit. AI can now reduce a drug discovery timeline from years to months. Imagine you having to take 2 years to find a good drug, and now it only takes 5 months. And then you also have the customization with AI. It allows for personalized peptides tailored to an individual's specific genetic markers, which if you follow HIMSS at all, that is what they're doing, personalized healthcare. The peptide market right now currently is undergoing a massive gold rush. Over the next 10 years, it's expected to more than double in value, shifting from a market dominated by metabolic treatments to one defined by targeted oncology, neurology, and non-invasive, the pills, right? So right now we're looking, the total market's around 80 to 140 billion. It's projected to reach 300 to 335 billion by 2033, 2035. So in about, 8 to 10 years. Now, this is a big deal right here. The FDA is setting up to possibly lift the restrictions. Now, a few years ago, they basically put some peptides in category 2, which banned them from doing any research and compounding and doing all this stuff. Well, recently, they convened a group of independent advisors to whether to allow compounding pharmacies, HIMSS, to manufacture certain peptides. As many as 14 of the peptides that they removed in 2023 are going to be up for discussion. 7 of them will be the focus on July 23rd and 24th, while another 5 will be reviewed at a future meeting in February 2027. So July of this year is going to be big for HIMSS because that's when the peptides could become legal again. And the interest just in the public view, you can see here in the last year, Google Trends, it's gone up a lot for peptides. The last 5 years, you can see, really in 2025, it's gone up tremendously. GLP-1 is a peptide. There's all kind of other peptides that other people are trying to look into. I've actually talked to someone who had a shoulder surgery, and he was just talking about, he said, BP157, and people are just looking into different things to heal themselves and get better. And so as you can see again, since 2004 to present, peptides this is a gold rush right there. So if this continues, if this wave continues, HIMSS seems like it's going to be in a perfect position to capitalize on it, right? Next, we have Celsius. Celsius is my number 2 stock to watch. Very similar to HIMSS in a certain way, right? The revenue went up 86%. As you can see, 89% North America, 24% international. But the net income went down 26%, right? The net income attributed to common shareholders went down 41%. The EPS went down 44%. But why? Well, the adjusted EPS was actually up 91% and the adjusted EBITDA is up 142%. So what's going on with Celsius? Why does it seem like their EPS is down? And why am I saying, what's going on? Well, a little bit different. They already made an investment, but a lot of it is still going costs into making their business better. They announced a 25-cent diluted EPS. But that was including an 87 cents that they had to pay out of their EPS just in distributor termination fees. Just that, 87 cents. If you add that plus a couple of these other acquisition and integration costs, you get $1.34. That is 5 times more, right, than what they actually announced. So they're making money, but they had to go through all this acquisition and integration costs and termination fees. And so, you look at it, the distributor termination fees, it was 13% of their revenue. All of this, right? They have the SG&A, all this stuff, the sales and marketing, we have all these things. It took up 44% of their revenue. But if you take away the acquisition costs, the penalties, the distributor termination, all this, the legal settlement, which wasn't really anything here. If you take away all that stuff, it was only 29% of the revenue, right? So that is a huge difference. Huge difference. So again, this is kind of hidden where right now their current numbers don't look so great, but it's about to get a lot better. And I'll explain kind of why. The consensus for the earnings per share of approximately 146 to 149 for this year. That is obviously 5 to 6x, right? This outlook reflects a significant recovery in profitability as the company moves past the heavy one-time distribution transition fees and inventory noise. The margin expansion, now that management expects to go back to the low 50% range. The Alani Nu integration is expected to be completed by the end of Q1 of 2026. And then the Rockstar Energy integration is also expected to be completed by the second quarter of 2026. They also have now, they're going to be fully integrated into PepsiCo, and they're going to have their network efficiency. So they're going to be able to do all kinds of stuff now with Pepsi. And then the revenue growth, right? They're planning to continue to grow the revenue a lot, supported by Alani Nu, which is projected triple-digit space gains. And I'm going to go over exactly something about that as well. And this is their earnings per share estimate. Now, if you look at the first quarter is estimated to be as much as they had the whole year of last year. When they release their earnings and they give out a really positive guidance, this stock is going to go flying. That's just my opinion. That's what I think. The potential headwinds, we do have aluminum and tariffs, and then valuation sensitivity. It is trading at a high PE a little bit, but once the earnings per share changes, it's not going to be. It's not really trading at a high, And this is what I was saying. The top 3 rewards, we just kind of went over the energy captain multi-brand strategy. Celsius is now a powerhouse, right? Including Celsius, Alani Nu, and Rockstar. And it's positioning itself as Pepsi's energy captain, right? Kind of like how, what's Coke? You have Red Bull, and then you have Monster, you have all that, right? I think it's Monster, right? But they have their own. Now Pepsi is now basically having Celsius and Alani Nu as they are the energy captains of Pepsi. The massive shelf space expansion, this is going to be huge. Alani Nu brand specifically is expected to jump 100% in shelf space, which is absolutely crazy. It already is growing so fast, and it's expected to jump 100%, and the earnings per share is already, everything is going to go in the right direction this year. And then the international runway, the international sales aren't great because they haven't expanded internationally yet, but they're going to because they have someone in charge of the international sales that's what he does, and he's going to take Celsius. This is Garrett Quigley. He has 25 years of leadership in PepsiCo, basically dealing with a lot of international stuff, right? So he's going to be handling a lot of stuff and doing it right. Costco just announced a competition. Let's be real. That's not a competition. And AI, right? Celsius is not an AI play. It doesn't get really hurt by AI. And so I believe I believe Celsius is a real good play against AI. It's something that's not going to be hurt by AI. And it's just, you can go with it. It's just a good play against AI, right? You can have the AI play. Of course, AI has made a lot of money for people. But at the same time, if you want something that's not necessarily tech and AI, Celsius is a good company for that. So I do believe Celsius is a really good stock to watch. All right, next we got up Salesforce. So Salesforce is part of this whole SaaS apocalypse that's been going on. Now, one big reason why, as you can see, the revenue was growing in the mid 20s, and then it's just gone down to now single digits. So that's scaring investors a little bit. What's going on, right? The revenue has gone down a lot. Now, this does happen when you start growing a lot more, right? Now they're making almost 38 billion rather than 17 billion. But the rate that they're growing is not staying steady that people were used to. So that's kind of scaring investors. Here's one thing that you have to remember. Transitioning out of Salesforce is highly complex. It's a very difficult undertaking. The platform's deep integration into the business processes, custom coding, and vast data volume create significant sticky barriers to exit. The data migration and integrity, massive volume, right? Large organizations often move millions of records, so that's just a lot to deal with. Complex mapping, Salesforce's unique data architecture rarely maps one-to-one to other systems, so you'd have to remap everything. And then the data quality, migrating dirty or inconsistent data without a prior cleanup initiative often leads to broken workflows in the new system. So it's just already right there, it's just the data in itself, and migrating data can be very difficult. Also, you have technical and process rebuilds, the customization replicas. Heavily customized Salesforce environments are difficult to replicate. And then integration breakdowns. Large enterprises typically have Salesforce connected to ERPs, marketing automation, and accounting tools. Each of these connections must be entirely now rebuilt. People don't want to do that. So the estimated time and financial cost would be about $150,000 to about $500 million, and it takes about 6 to 12 or more months just to transition out of them. The hidden expenses beyond just the licensing and everything, right? The cleansing, all that stuff, you have the 5 to another 50,000. And then you also, a lot of these people are on contracts, right? You're in a lock-in, so you're on some kind of contract. And if you're trying to get out early, then you have to pay for that as well. You also have human factors. User resistance. Employees who are already accustomed to Salesforce now have to learn a whole new interface, and it becomes just a difficult undertaking, new training, right? You have training overload, so now all these large teams have to retrain. You don't want that. So the top 3 rewards: dominant AI monetization via Agentforce. Agentforce is now their new thing with AI, right? And so it's reaching 800 million annual revenue run rate as Q4 2026. So they do their financials a little bit differently the way they announce them, right? Aggressive capital return program. They are now going to be putting 50 billion of the authorization, right? They have authorized now 50 billion buyback, and then deep valuation discount. Following all of this, stuff that's been going on, it's now roughly around in the mid 20s, where it has been with the 3 historical average of 132 XPE. That's just ridiculous. They should never trade at that. It should be trading somewhere in the 20s to the 30s. So as long as they continue to grow, if they can continue to grow, and all this AI spending, kind of helps their company grow, then they'll be fine. So I did a quick just a projection, and I want to see how far how well they could do, right? What would be the stock price? The revenue growth, I have them just growing at 10% from here, right? 10%, that's what they're going to be growing. So the net income, I have them growing at 20, 10, 20, and 10. This is about roughly what they were growing, right, on average. And so if you look at it, you have, by 2030, you're looking at a 16% on the low end of compounded annual growth rate, and then a 32% compounded annual growth rate. So if you're somewhere in there in the 20 to 25 range, 25% of compounded annual growth, that is a lot better than the market. And so, to me, this would be a buy at this current price. This was taken when it's at 182, as you can see. So I do believe it is a buy. I actually bought it like 190, I think, 199, somewhere around there. So, but I'm just buying partial shares here and there and buying. So, anyway, that's where I think Salesforce might end up. Netflix is my number 4 stock to watch. You've heard of Netflix. I give them an A- on their latest income statement. They did their earnings release. Let's go over that. The revenues went up 16%. Not bad. You'd like it to be a little bit better, but again, when you are such a big company already, it's hard to grow too much, but they're growing 16%. The revenues. Now, the cost of revenues went down, it grew less than the revenues, right? Which is good. I want the expenses to grow less than how much they're making. But the sales and marketing grew 22%, technology development grew 17%, and the general and administrative grew 43%. Overall, the operating income grew 18%. Still, I do not like to see these numbers that high. I do not like to see that. I really hope they can improve that on the next earnings release. We do have their net income growing at 83%, but that was because it seems like they had this other income, interest, whatever it is. It's a one-off, and they got almost $3 billion, right? Without that, this is not nearly as much, right? So we need to see what happens after this is not there anymore, and what kind of stuff. Their next earnings is going to be pretty big. The earnings per share, of course, went way up because, again, they had this one-off. So depending on the next earnings release, I mean, this is an A- if you're growing your revenue 16 and your net income 83 and your EPS at 86, but what's going on behind it, not 100% sure. But I'm going to go behind just the business as well. First, let's go over some of the numbers. As you can see, the revenues, they've grown usually around 30, mid-20s to 30s, and then it dipped. It dipped hard, from all the inflation and everything, and I don't know exactly why they didn't grow so much, but they grew only 6.5 to 6 in the mid 6% for 2 years, from 2022 to 2023. But as you can see, they're now kind of getting out of that, and they did just do a price raise, which I know because I'm a customer. They just raised the prices, so this, I think, number is going to be pretty much where we can kind of look at them to be doing. They're around the 10 to 15%. The net income, they obviously always find a way to rate that. The net income is always higher than the revenue, as you can see, right? Except for here, they lost 12%. But they are, they're bringing in more net income percentage-wise, their growth rate, more than the revenue, right? So, okay. Another concern for Netflix, a lot of it was liabilities. And as you can see, that really staved off over here. They stopped. It was starting to grow tremendously. You went from 10 billion, 11 billion to 15 to 20 to 26. I mean, within just a few years, it started going really, really high up. And then it's only at 29, after, 6 years? So their liabilities have staved off a lot while their assets have continued to grow, which I do like to see. Now let's talk about the business, right? How big is this business? Now, if you have not heard of Netflix, then you can click out of here, because I doubt that. They are the biggest, some of the biggest global streaming services by subscribers, by paid subscribers, is Netflix, Amazon, and Disney. Netflix, the clear global leader with over 300 million paid subscribers in 2025, operating in over 190 countries. The next one is Amazon Prime with 200 million users. Netflix is clearly the dominant one, right? People generally refuse to cancel these high utility services that offer significant convenience, productivity, or entertainment value, particularly like Amazon Prime or streaming platforms like Netflix, Spotify. These are retained because they provide indispensable daily value, such as entertainment, that outweighs their cost. People are like, yeah, I'll pay a little bit of money, I get all this entertainment. Top subscriptions people refuse to cancel. Amazon Prime's one, and then streaming services, Netflix and Spotify. Despite rising costs, like recently, these are often considered core entertainment. So Spotify is kind of seen as like a core thing for people, right? I cannot imagine me canceling Netflix. I don't see it, right? Unless I'm financially strapped. And the top 10 global streaming services, as you can see, Netflix, Joy Hotstar is some Indian streaming company, but so they have 280, but still, even at that, right? Some of the company that's out of the blue, you might have never even heard of, and they're in a country that has a huge population, and they're dominating that. Still, Netflix is bigger. Netflix is way bigger than that. So as you can see, Netflix is just dominating the streaming services. So if their revenue is growing at 15%, just 15% per year, their net income grows at 25% per year, you have a compounded annual growth rate of between 18 to 31% in a few years, right? So you're looking at maybe 22 to 25, 26% in the mid-range, somewhere around there, which is, again, completely beating the market, right? If you do that over a long period of time, you're gonna beat the market very well. That's really good. So I do believe, looking at this, by doing these projections of just 15% revenue growth and then 25% net income, I do see that it could be a great investment. Now, of course, anything can happen. Anything can happen at any time, but Netflix is not going anywhere, in my opinion. Last but not least, ServiceNow. ServiceNow, as you can see, the revenue, it was in the 30s, high 30s, mid 30s, and then it's dropped down to like the 20s, now low 20s, right? So again, investors do not like to see revenue growth go down like that. Even though you were only making $3.5 billion in 2019 and now you make $13 billion, the rate of growth still scares investors. That's what happens. Their net income, right, kind of gone up and down, up and down. It didn't go up too much right here. It's just been all over the place, right? But recently, as you can see, it boosted up a lot in 2023, and then it's kind of stayed right here. So exactly what had happened, gonna explain. Their net income spike in 2023 was primarily driven by a massive one-time tax benefit. They recorded a $910 million benefit onto their earnings, and it was causing reported net income to skyrocket by 432% to $1.7 billion. Subscription revenue still grew at a healthy 23 to 25% throughout the year, though. So even though, yes, the net income went up and skyrocketed and all that stuff, their subscription growth was still, the business was still running as usual. The net income declined by 17.7% in 2024 as tax expenses returned to a standard provision of $313 million. Then they also had rising costs, acquisitions of MoveWorks, and they funded AI acceleration. And then the revenue strength, despite the lower net income, subscription revenue continued to grow at 21%, reaching $10.65 billion. So now, right, they're stabilizing their profits, right? They've recovered, the net income has recovered to $1.75 billion as AI products like Now Assist have began scaling in large accounts. And the guidance, 2026 stock prices slid after management lowered operating margin guidance to 31% to account for ongoing AI integration costs. So again, just more integration costs with AI. That's just what's going on. So AI is either going to make you money or it's going to cost you money, right? I give them a C-. Their total revenues were going up 22%, but again, the cost, right? It cost 46% more. It went up 46% more for a subscription, 33% for total services and others. So it went up a total of 44% of the total cost of revenues. And the gross profit only went up 16% compared to 22, right? Netflix actually had a gross profit of 18% compared to their 16% growth, right? So even though, yes, these were higher, their gross profit was still rising higher than the revenue, which was good. Obviously, these are lower than the total revenue growth rate, right? The other expenses like sales and marketing, research and development, but the general administrative was up more, so I put that in the red. And the total operating expenses went up 17%, which again is good because it is lower than the total revenues. And then net income went up only 2%. They've been doing a lot of integration and a lot of costs, a lot of acquisition, a lot of stuff going on. So I understand that their profit isn't there right now. I do believe in the company, and I'm going to go over why I believe in the company itself. The cost of subscription revenues increased primarily due to the early close and integration of major acquisitions, right? So it does provide some near-term headwinds. The acquisition of Armis for $7.75 billion significantly impacted the cost structure. And then to support the massive growth for their AI products, which has now doubled in value, ServiceNow has significantly increased spending on the data fabric and compute power needed to run these agents. So that's going to happen. Now, the long game view, management maintains that this spending is an investment towards future growth, and they will return the company to margin expansion by 2027. So yes, this is a long-term play. They do, though, have 630 customers spending more than $5 million annually. Imagine that. You have 630 customers spending more than $5 million every year on you. That's crazy. The notable major customers, JP Morgan, Goldman Sachs, you have Amazon, Microsoft, United Health Group, CVS, General Electric, Stellantis. You have the government, Department of Veterans Affairs, Department of Defense, right? So they have some big time clients that probably are not going to move away from their product. And why? It's considered one of the stickiest products in enterprise software. How sticky? It's best-in-class retention. First of all, the company consistently maintains 97 to 98% renewal rate. That means 97 to 98% of their customers continue to come back. And it doesn't just sit alongside other tools, right? Their whole software. It acts as a control layer that coordinates across all IT, HR, and legal departments. Replacing it requires reworking the very way a company can function. And then the net dollar retention, even not better than the best-in-class retention of just holding, their clients, but then the NDR. Oh, I gotta charge my computer. Now, their net dollar retention, the NDR, is almost just as important as the best-in-class retention, right? Of keeping 97 to 98% of their customers. They have their customers that are staying, they actually spend more over time. So they're spending 125%, right? So when they come back, they're not just coming back spending the same dollar amount, they're spending 25% more. So they keep the customers and they keep the customers buying more, spending more. So the difficulty of transitioning away from ServiceNow is often described as a nightmare scenario for large organizations due to three main barriers: complexity and time, customization trap, and institutional knowledge. This is all very similar to Salesforce, right? Very similar to Salesforce. When you have your company integrated into a software like this, it is very hard to get out of it. That's just what it is. So this is something interesting too, right? When we look at their revenue, 2023, 2024, mid-20s, the stock went up 208%. The revenue, 21%, 22%. It went down a little bit, but still mid-20s. The stock's down 61%. Stock market's emotional. That's what's going to happen. You're going to have emotional investors, and that's just what happens. You just got to stick with it. You could have bought this ServiceNow in mid-2020, and then you wouldn't have made any money right now. That's pretty insane to think about. But the company's grown a lot since mid-2020, right? So, I don't know. And to put exactly what they do, right? Imagine a giant school where teachers, principals, janitors, office staff are all trying to do their jobs, but they keep losing papers, forgetting where things are, waiting forever for an email. ServiceNow is like the magic to-do list program that connects everyone in the school to get things done faster, right? They have the fix-it button, which if something breaks, boom, you hit a button and it will find someone to do it and do it really fast. They have the robot helper, which it will provide the person to help you fast, and then keeping track, it keeps track of everything. So this kind of software is very valuable for companies, and companies don't want to leave it because, again, it's very expensive and very difficult to do that. So lastly, stocks to buy, stocks to watch really. HIM, Celsius, Salesforce, Netflix, ServiceNow. I do believe all 5 of these are going to be up significantly over the next 12 to 18 months. As you can see, all of these stocks that I have chosen, the S&P 500 is up about 30% in the last year. All of these are underperforming the S&P 500, just like I showed you how they've been performing over the last 1 month, 6 months, and 12 months. They are all underperforming, but that is what I want to buy. I want to get a company that is good, but the stock is underperforming. So as you can see, all these stocks are underperforming. You have HIMS HIMS is the only one that's up in the last year, and that's because it went up 44% in the last month. Celsius is down 7%, Netflix is down 17%, Salesforce is down 32%, and ServiceNow is down 51%. These are all good companies that are just having weak stocks. That's it. Thank you for watching. I really appreciate everyone who is still watching at this time. Please go ahead and give a like and subscribe. Where is it? There it is. Give a like and subscribe. I really appreciate everybody. And yeah, if you're just aware and prepared, you're never going to be scared of the crashes and corrections that will eventually come. and that's just how it is. So yeah, thank you for watching, and never forget to earn it, save it, invest it, buy low, sell high. I want assets, not liabilities, and you can count on compounded interest.